The looming Canada-U.S. trade war and a potentially weaker Canadian economy and a weaker Canadian dollar could make publicly traded Canadian companies attractive targets for shareholder activism. Wes Hall is executive chairman and founder of Kingsdale Advisors, and he joins us now. Kingsdale Advisors, I should say. Wes, thanks a lot for joining us for this. Take us through the concern you have that, or the perception you have that some Canadian companies could be targets for shareholder activism, which can be positive for shareholders.
Well, Paul, first of all, thank you very much for having me. And I don't think it's really a perception. It is a reality. The fact of the matter is that the Canadian dollar is down significantly. And the stock market is not as robust as we'd like for it to be. So publicly traded companies are extremely cheap these days. In addition to that, the U.S. dollar is on a tear. So if a U.S. company, by the way, you should know that in a lot of cases, companies use their stock price as currency to do acquisitions.
Of course.
So if a U.S. company comes over here, they decide to use their stock price as currency, they can buy a lot of things for cheap. So my advice to the Prime Minister is that as much as we need to look at helping workers that have been displaced by this tariff threat, and we have to look at helping companies as well to protect those companies from hostile takeovers and the like here in this country.
What kind of help would that look like?
Well, we have this great Canadian company called Couche-Tard that's tried to buy 7 & I, which is 7-Eleven, and the Japanese government says, well, for national security reasons, you actually can't buy this company. Who would have thought that a convenience store would be considered to be national security? We could apply the same threshold, at least for a period of time, to Canadian companies, especially companies that are providing critical minerals that we need, which is actually our defenses. And to say, those companies are off limit in terms of takeover bids of any sort.
So you're in favor of regulation. I mean, we already have a review of foreign takeovers. It occasionally has resulted in foreign takeovers being blocked. Do you believe that needs to be stepped up now?
Well, I think we need to think about, just like we're doing right now with tariffs, there's a lot of things on the table right now that we have to do to fix our house internally. And we need breathing room. We need space for our company, for a dollar to recover. And so during that period of time, I'm not suggesting that we do this indefinitely, but certainly for a period of time, we need to make sure that there's some protections are in place for vulnerable Canadian companies.
Okay, what sectors, you've mentioned the critical mineral sector, what other sectors do you think might be most attractive to takeovers, foreign takeovers, or activist investors?
Well, if we look, for example, in 2006, we had Inco that was involved in a hostile takeover bid by, at the time they were called CVRD, they called Valet today. And shortly after they launched their bid, or actually just before that, Xstrata out of Switzerland launched a hostile takeover bid for Falconbridge. So we've seen, and at the time, you may recall that nickel was just on a tear. The world needed it in abundance, and we had a lot of it. And as a result of that, there was a hostile takeover bid for both those great Canadian companies. So we believe that the same could apply today.
Okay, what do corporate boards need to do? I mean, ultimately, the performance of a company is the responsibility of management and the board. It's the board that makes the decision on pressure from activist investors or a takeover approach. What do boards need to understand?
I think the board needs to understand that your company is vulnerable today and that you need to do things to make sure that you protect those companies.